Hello, I'm Christina Deligianni, the co-founder of ESGreece, and I will be talking about sustainability and ESG finance and investment trends globally and in Greece. So, what is the global emergence of sustainability-linked finance and investment? According to BlackRock and UNCTAD, the projected global growth of ESG ETFs is exponential. And we see that now in 2021, there are 80 billion US dollars on ESG ETFs that is projected in 2028 to reach 400 billion US dollars according to BlackRock. Let me make a distinction between sustainable investing and impact investing because I believe this is very crucial in our discussion. Sustainable investing allows investors to ensure they're not investing in companies with a net negative impact, whereas impact investing goes well beyond avoiding harm and managing ESG risks. It aims to harness the power of investing to do good for society by choosing and managing investments to generate positive impact. ESG is getting ahead of other sustainable finance approaches, and indeed it is getting traction. The global total of assets under management that followed some form of sustainability approach amounted to close to 60 trillion US dollars in 2020, or more than half of all other assets under management. And in the past, we would talk about negative screening of investments, but now we see that ESG integration is actually getting traction. The demand for ESG-oriented hedge funds is huge. According to, this is a KPMG survey. According to this manager survey, 85% of institutional investors are the biggest drivers of demand for ESG-oriented hedge funds. 55% of ESG-oriented hedge funds continue to target alpha returns while managing fat-tailed far-off risks. 18% of hedge fund managers have integrated ESG factors across their strategies, and 63% of progress has been hampered by the lack of robust templates, consistent definitions, and reliable data. Reliable data is an issue that has been debated and discussed for so long. So what is the global and EU scene for sustainable linked finance and investment? Well, there is the SDGs investment gap. The total annual investments in SDG related sectors in developing countries will need to be between 3.3 to 4.3 trillion US dollars. The IMF estimated that for 5 priority areas, that is education, health, roads, electricity, and water sanitation, an additional public and private annual spending of 580 billion US dollars for low and lower middle income countries and 2.1 trillion US dollars for emerging countries will be required by 2030. When it comes to the European Union, the European Commission has announced the EU Just Transition Fund. This is a key tool to ensure that the transition towards a climate-neutral economy happens in a fair, in a just way, leaving no one behind, mobilizing up to 150 billion euros over the period of 2021 to 2027. The Just Transition Fund consists of 40 billion euros, generating at least around 100 billion investments, and there are so other schemes. The Invest EU Just Transition Scheme mobilizing 30 billion euros in investments, the EIB Public Sector Loan Facility, which is 10 billion euros in loans, and it's backed by 1.5 billion of the EU budget. But this is not just only funding. With the Just Transition platform, the Commission will be providing technical assistance to member states and investors. So, what parameters are sustainability-linked ESG finance and investment cases are looking for? So ESG disclosures is a big issue because it enables investors to make informed decisions by identifying those companies that may pose a risk or perform less due to sustainability or ESG failings. Transparency and proactive disclosure on ESG issues is the expectation rather than the exception, and the importance of ESG disclosures is likely to grow. The criteria could be environmental factors, social factors, governance factors such as accidental pollution, waste, transportation, child and forced labor, customer relations, supplier relations, working hours, health and safety, anti-corruption, lobbying, product safety, shareholders, audit and internal controls. I will give some global large-scale examples of sustainability and ESG finance and investments, which I think are very important in our discussions. So the Mubadala Group, the Abu Dhabi Sovereign Wealth Fund, has established a responsible investing arm. Mubadala joined the One Planet Sovereign Wealth Funds initiative, a coalition established to integrate climate change into its priorities. And some of the objectives of their responsible investing policy is to identify and understand and proactively manage ESG related principles and considerations at the asset, portfolio, and corporate levels. There is the case of the retail giant Majid Al Fattam in the Middle East, in the GCC countries, that has secured its first sustainability-linked loan with a value of 5.5 billion dirhams. That's 1.5 billion US dollars in August. This 5-year loan is structured as a revolving credit facility, and it includes a gender diversity target for women to constitute 30% of board members and senior management roles. Munich Re has launched its second green subordinated bond after a successful issuance in 2020, and this is designed to reinforce its capital base with a focus on emerging growth opportunities in reinsurance markets. The volume of this issue is 1 billion euros, and the bond has a coupon of 1% and will mature in 2042. The Dubai headquartered logistics firm DP World was the first company in the region to sign a 2 billion US dollars green loan transaction, and this was a huge news recently. And in 2019, DP World established a sustainable development financing framework because this enables it to issue green, social, or sustainability bonds and sukuks. So what is happening in Greece? Well, it seems that sustainability-linked finance and investment is picking up speed and gaining traction. According to Bloomberg Green and other sources, Greece's plan for using the European Union funds, the Just Transition Fund and other funds to combat the effects of the coronavirus pandemic will accelerate the nation's transition from fossil fuels to a greener economy. Both domestic and foreign companies are expected to step up after almost 18 billion euros of public and private funds have been earmarked for everything from solar panels to energy storage to big energy projects. And here are some cases of private and public entities would have done in the direction of sustainable investment and sustainability linked financing. The Hellenic Petroleum, this is Greece's largest refiner, will construct 18 solar parks with a total installed capacity of 204 megawatts in Western Macedonia, which is a region that is very much coal dependent. Terna Energy, this is a public company, is planning a 60 million euro pump storage project in Western Greece. And this will be a way of the company to also boost local employment. Greece's public power corporation, the public power company, and Germany's RWE have agreed to spend 1 billion euros on solar parks with a capacity of 2 gigawatts through a joint venture, also in Western Greece. There's also a group of Greece's largest energy producers and providers that include Motor Oil, Elas, Sterna Energy, the TAP. This is a trans-Adriatic pipeline. They have submitted a proposal for a green hydrogen plant, which will cost 8 billion euros. Mytilineos and the Public Power Corporation have also indicated that they're looking to enter the offshore wind industry, and Greece will begin discussions on a national hydrogen strategy next month. There are also other plans in Greece because there have been a wave of green investments on some small islands, on 20 to be specific, small islands. And in a few years, tourists that are very environmentally aware and they're visiting Greece could be able to choose secluded destinations that produce their own energy and have all electric transportation. When it comes to the Just Transition Fund in Greece, this amount, the total amount of funding, including of course, the private resources that will be leveraged, is estimated to exceed 5 billion euros, both from EU and national resources. And thus, this will be a way to safeguard employment, to secure jobs, and to create new ones. And it will also offset all the effects of moving from a coal-based economy in some areas to greener options, and they will maintain and strengthen the social fabric. They will also ensure the energy self-sufficiency of the transition areas and the country in general while developing the local economy. Well, thank you very much. I'm looking forward to your questions. Thank you.